Welcome, Manish, to another edition of Conversations. This is Deepak Shenoy here with Manish Jain. Manish Jain is, I've introduced him last time with the glorifying thing, but let me just say that he is the go-to guy for any car that is more expensive than you can buy. So, and he works for M-Profit, which is a portfolio management software sold in India at a ridiculously cheap price, may I add. And he is, of course, we worked together earlier in during the days of algorithmic trading and so on. So, welcome, Manish, to the show. It's great to be back here with you again.
Yeah, thanks again for having me, Deepak. And the last time was really enjoyable. So I guess we're going to do this more often, which is kind of nice because there's a lot of stuff that happens. And I think it's kind of a good format to kind of just talk about what's happening out there. And hopefully the listeners like it as well.
Absolutely. I think the feedback last time was fantastic. So let's just carry on. I think one of the topics that we've been talking about that is like prime on people's mind is ULIPs, and we're doing a different twist on it this time.
Yeah, I know we've been talking about ULIPs, and, I, for the longest time, was very against ULIPs. But recently, I've talked to a couple of people, and they kind of kept on asking me, like, why are ULIPs bad? Why are the ULIPs bad? And once you go beyond the fact that, yes, the ULIPs of the last, 3-4 years, they were heavily, in favor of the commission agent who was making lots of money. Now that they've reduced those commissions, it may not be a bad option, for certain types of people. And I think that's kind of what we want to talk about is it's not bad, for everybody, but, for some people, it may not make the best sense, and I think that's what we have to kind of demystify, who it's good for and who it's bad for. And just like anything else, like any other product, it fits a certain type of, user, and let's try to identify who that user is for ULIPs.
There you go. I mean, that's the point. What's good about ULIPs? I think that's the focus of this session. And I think one of the things that, let me just dive right in and say, I have been an anti-ULIP guy for a really long time. And I think I like to see the other side of the story, a story that perhaps I miss, perhaps it appeals to a certain class of investor, a certain kind of investor, and it probably is the best thing for them. But, one of the things that we've always got is that ULIPs, are very difficult to quantify in terms of, once I buy a ULIP, I don't even know how much it's valued at today, because not only does the NAV change on a daily basis, they also have a ton of units that are deleted or cancelled because of fees and costs and mortality charges and something else. So, at any given point in time, not only does the value per unit change, but also the number of units I hold keeps changing. So, every time I need to know what my value is, I can't just store it in a spreadsheet on an online software or a site and let them calculate what my worth is, because, everything changes. So
right, and I think that's one of the issues about ULIPs is, they've kind of made the expenses and the charges very mystifying, so you don't really know. And that has been an issue with online portals and even M-Profit. People have always asked us, can you automate the whole process of giving us price updates for ULIPs and then calculating it? The basic problem is let's say you have 100 units today, and after 5 years, you will not have 100 units. You'll have a subset of that, because every year they'll deduct maybe 1 unit, 2 units. So the problem is people may not update the number of units. So we may give them a price quote, but the number of units has changed. So then actually they don't know how much the product is worth because they've forgotten to delete the number of units, as you say. So I think that's kind of the issue on the maintenance side. But then I also tell people that this is a long-term product. This is like you're saying 5-10 years. So do you really need to track it on a weekly, monthly, basis? It really should be on a yearly basis. You should update, okay, I started with 100 units. Now I've got 95 units, and this is the amount per unit, and then that should be the end of story. You should do that every year. And it shouldn't really be one of those things where you're tracking on a daily or a weekly basis. And I think that's kind of what people, more than anything, is the demystifying. I'm hoping now, maybe when the statements come back to people, maybe they'll break out the charges for each individual thing, and then it'll make it a little bit more, presentable of where the fees are going, so people can actually calculate it themselves.
You bet. I think one of the other parts of that problem is that even if you do it once in 3 years, you don't really know the extent of the risk that you take. So for instance, if you look purely at an NAV, I could find out the risk that I had in my portfolio because the stocks could go up 30%, down 30%. I know that I have a 30% range in which I operate. But because of this ULIP NAVs changing, I don't really know the range of risk that I'm getting. And even if I updated it once in a year and then try to get it, the first time I'd even get to an analysis of whether I made the right choice is probably 3 or 4 years down the line.
Right, and I think that's an issue, So what ends up happening is people really try to compare that versus an equity product and saying, well, here's the returns you get, and it's not good, and it's sort of one of those things where you don't know for 3-4 years, so you kind of have to have a leap of faith, and I think that's where it may work for some people that are very used to switching in and switching out of products, because this way you're forced into it, and if you don't have that, I guess, the ability to hold on to something for a long time, this may be the product, because then you're really forced into it. Versus if you get an index fund or you buy some stock, you can sell it at the drop of a hat. But a ULIP, if you do that, then, if you don't pay your, premiums, things like that, then you may go into some heavy losses.
You actually got a good point. The forced saving piece, which I usually say is a bad thing, probably is a good thing for some people because, minus the forced saving, they would not save a single rupee.
Exactly. And so I think that's my thing is I think it may be good for those kind of people that just don't have that habit or, they get spooked very easily by the markets. Oh my gosh, the markets fell by, 15-20% over a period of 4 or 5 months. And they just said, you know what, this is a bad thing.
That's true. And that I agree. I mean, although I must say that, the one way to solve that is to tell these people that this is a long-term kind of situation. There is the other extreme is to just say, listen, just save. Forget about why you need to save. Just keep saving, and then you'll thank me one day. That's an interesting point. But I mean, at the same point, one of the arguments I've always had is should you mix insurance and investment? Are the two something that really mix?
Yeah, and I think that's what most advisors, if you read in the paper, they'll always say that, most, investors get very confused between, these products, and you should look at insurance as an expense and don't try to mix something that's an expense with something that's an investment. But, the problem is people feel like, they're getting two things for the price of one. They're getting insurance cover and they're getting this, equity product as well. And I think that's what a lot of people like because they feel like they're getting a 2-for-1 deal. But I personally like to keep things very simple. Whenever I hear all these different charges, mortality charges, surrender charges, overall costs, all these different things, it just kind of concerns me. Whereas, I know very simply if I get a term life cover, end of story, I pay the premium for the year and I'm done. And then I do that next year. And then I put away some money in equity product. And let's say an index fund, and I know the expense ratio, and I'm done with that. So it's very simple. So for me, part of it is also simplicity. I like things that are very simple and easy to understand. You always hear some of those analysts that say, invest in things that you know. I say you should invest in things that you can understand and you can decipher mathematically on an Excel sheet.
I can't agree less because, I mean, apart from ULIPs, I see that a lot of investors get trapped in products they really don't understand, and if you don't understand it, you shouldn't buy it, regardless of the fact that it could make you a ton of money. But I guess to a certain extent, if they were to, really cut down a lot of the, jazz out of the insurance products and just kind of present it in a small, very narrow focused way, ULIPs could be quite an attractive product. For someone especially who wants a forced saving product.
Right. And the other thing is, I would also say is ULIPs are one instrument out of many. So if you're the person that's buying only ULIPs, that's also really bad. So my guess is, you should be buying a variety of different instruments, and ULIPs would be one of them. So if you look at the overall asset allocation, you should have little bits and slices of every different asset class there. So I think that's the other important point. Even if somebody says, I'm a diehard ULIP investor, fine. Buy a couple of ULIP instruments and then maybe buy some equity instruments and then buy some other things. And you shouldn't have only one type of instrument. So even that, I say, okay, if someone's diehard and getting it, get one. This way he gets his insurance cover that he wants, and then maybe a little bit of it will go into equities, and then he feels like he's getting 2 for 1. But, that's the other thing is you have to spread out over various different investable instruments.
Which is true. I mean, one of the things I get for ULIPs as a huge advantage is that you can invest in a ULIP in equity, shift over to debt, shift over to balanced, or move these funds, in different allocations. So, some of these funds have something called an aggressive fund, a maximizer fund, a conservative fund. So you can move between these funds. So if you're concerned about market timing, you could just move into debt. If you're concerned that, that the equities are undervalued at some point, you can move back into equity. You can do this if you were to do this with a mutual fund, for instance, you would have capital gains on exiting one instrument, new entry load on getting into some other instrument, all sorts of things that happen. And these transactions just cause you untold amounts of grief, versus with a ULIP, you don't have that. You can just do it, with a click of a button, and there's no tax implication at all.
Right, and I think that's probably one of the best features of these products, and I'm surprised they don't actually talk about it more. But I would say that is a great thing. But then that also assumes that person knows when to do it. And as we know, it's very difficult to time the market. And I think that's what ends up happening is people may mistime it, and then they feel like, well, I didn't even do it correctly. But that is one of the added benefits of getting a ULIP is you can do that. You can move from various different investable instruments into different ones, and you don't have to pay any capital gains because you're basically just moving from one to another. It's not like a switch out, switch in. It's actually you're kind of moving it from one to another, and you're not actually selling anything. So that's actually very efficient from a taxation standpoint.
That's true. And we've got people who are forced saving. We've got people who can do market timing. So these are the kinds of people that you would say ULIPs are useful for. But one of the other things that I get is, it's useful for a goal. So for instance, you're saving for a house. If you've bought the house, if you die, insurance takes care of the fact of the remaining payment of the house. But then if you keep saving money, it pays off the principal eventually. Is that something that, is useful, a ULIP is useful for versus some other form of investment?
Yeah, no, I guess, that is definitely another one. So, I think that's kind of the third category where it makes for someone where, you've got this, goal that you're planning for, and then you can say, okay, I've set aside this money. And again, that's for people that maybe are not very good at saving towards the goal, but this kind of forces them. So that may be good. And I think that's probably the third option. And, beyond that, I kind of wonder. But yeah, I think it's not bad for them as well.
Yeah, that's true. And of course, now the rules have changed. So earlier we had this 60%, 80%, 90% of your first year's premium going to costs. You've got a new structure really of the ULIP rules. What do you think that has done? In terms of perception and in terms of the quality of ULIPs that are coming around after the new rules?
Well, I think one thing is, I think now people realize that, ULIPs, the reason why they were so popular were because the agents were making so much money. Now people understand that. So when I tell people, hey, if you're buying something and somebody's making 30% off of you, what do you think they're going to tell you? They're only going to tell you that this is a great product. So now people are understanding. And once again, I think this is what we talked about in the first, technology talk was, there's a lot of investor communities out there on the internet where people are discussing these products, and you're getting probably more cons than pros. And I think that's what we're trying to bring, that there are some people that may actually benefit from it. So I think now with the new rules, they're making it more transparent as far as the costs are concerned. It's still a little bit more expensive, but then I guess part of that expensiveness also goes into the fact that you can switch between the different products without any tax and taxation issues, and that may be how you can justify it. But I still find it a little bit steep. But as we mentioned, for some people, it's either that or they just don't ever save.
That's true. Yeah, one thing that I've been coming across recently is the fact that the surrender charges have been reduced substantially. Earlier, I think for the first 3 years, you'd lose all your money.
Oh,
So that was before 2010. You'd lose all your money in the first 3 years. After the third year, they typically charge maybe 5 or 10% in the fourth, and maybe 3 or 5% in the fifth, and usually it would kind of go into a zero zone after 6 years. But now what they've said is you can't lose more than 6% of whatever is in your fund, regardless of when you exit. If you exited on the day after you gave the money, whatever was allocated into your fund, you lose 6% of that, and that's it. You don't get the money until 3 years after you paid your first premium.
okay.
Because it's kind of locked in. So what happens is they just put the money, they're forced to give a 3.5% return. So it's like a savings bank account deposit.
Okay.
So they just give you 3.5% or I think 4.5%. That's the rate that they've talked about. 4.5% for about 3 years. 4.5% per year. But these surrender charges have gone down from the 100% ranges to literally 6%, and sometimes the 6% really means nothing, because if you lose 6%, you make 4.5% a year as interest, and then it kind of makes up, so you get back most of what is your fund value.
That's actually pretty that's pretty attractive, and that's a big thing. I mean, going from 100% to only 6% is a drastic cut.
And honestly, what the other problem right now that I'm looking at is, the insurers seem to make a lot of money out of these surrender charges. The way I've been looking at policies in the disclosures, more than 80% of the amount that they disburse every quarter, they're supposed to release this data every quarter, more than 80% of the money goes towards surrendered policies. So,
really?
Amazingly, so it's not people dying, it's not people maturing their policies, it's not, people doing something else with it. It's people surrendering before the policy is complete. And I assume that a significant amount of money, because a lot of people would have these high surrender charges for policies taken before 2010, that the insurers would make a lot of money on that. Now nobody's talking about this, and insurers don't really segregate their income as this much I make from surrenders, this much I make from something else. But I imagine that if surrender charges are going to be this low, this is going to seriously, hurt their profitability.
Oh yeah, definitely. But I mean, I guess that's what it's showing, that the insurance regulators kind of saying, okay, let's really make sure that the consumer is benefiting. Previously, I think it was the other way around, and I think now they're trying to be more customer centric.
You bet. I mean, I must praise them for it. At least it's come, even if it's after 10 years. Heck, it's a better thing than others. The other thing I've heard about is that because of the census, the amount of insurance you pay for mortality charges is going to come down. Because every census, they kind of take a call on what the average mortality rates for the average Indian is. So I think last census it was 63 and expected to go up to 65 or 66. And the longer you're expected to live, the lower insurance you have to pay when you're younger than that age.
Of course. Right, makes sense.
That's the other thing to look forward for. Although it's not applicable only to ULIPs, it will probably be applied to the whole spectrum of insurance products. It just means that at least one cost comes down.
Right.
So, the other piece that we were talking about is, and of course we've talked about the changes. We've talked about who ULIPs are good for. Who would you say should not take a ULIP?
In my mind, I would say if you are you have some idea of in the financial markets. You kind of think what's good as far as buying and selling stocks. Then it makes sense that you kind of just do that on your own and just get your own very simple term life insurance cover. So the guy that kind of is playing the market, I would say even if you're just looking at just getting an index fund, so get an index fund, get a term life cover, and end of story. Even if I personally think this idea of switching, it does sound great, and there is some great tax benefits, but I still think people won't be able to correctly time the market. It's very difficult. I mean, when you look at these big banks, these, big private wealth managers, even they can't time the markets correctly. I mean, so I think it's one of those things. It's a great selling point, but I just think in the end, it's really tough for somebody to do it. So who I think probably should stay away from ULIPs are people that just feel like they can do it on their own, or they just want to get something that's very simple, and that is they want to view insurance as an expense. And then they want to view investments as their investment part, where they can do it on their own by getting an index fund or getting a mutual fund or investing in direct equities.
Right. And I guess one thing I would add to that is, probably people who are widows or retired people don't probably need a ULIP, especially they don't need the insurance part of the ULIP.
Oh, absolutely. I mean, that is, and I think that may be where there was a lot of mis-selling. People were telling, people, hey, you get this, and at that age, you just don't need it. And I think that's maybe where a lot of the mis-selling was also occurring. And I, in fact, I just got an SMS on my phone a couple of days ago, and it looked very similar to, what the ULIPs are. You paid 1,300 rupees every day for I don't know how many years, and then all of a sudden you get this big amount at the end. So 1,300 doesn't sound like much, but it's, it's like 30,000 rupees at the end, almost 40,000 rupees at the end per month that you're paying. So I don't know. I mean, I just looked at it and I just kind of said, okay, this looks like almost like some sort of, ULIP type product that probably is not all that great for me. So it's still happening, and I just don't know why, but I think the regulators are trying to do, there's only so much they can do.
That's true. And sometimes I feel you shouldn't fight it, just go set up a ULIP yourself. 1,300 rupees a day from a lot of people can make anybody very, very rich, right? So.
Yeah, and that's the thing. So, and I mean, the other thing I look at is, are these guys really managing the money great? I mean, I would like to be able to see the guys that manage the equity portion of the fund, the guys that manage the bond fund, all these different things. I'd like to actually see who it is, what the returns are, all these different things, so I can compare myself. But I think that's kind of, it's not as transparent as we like. It's somewhat opaque. So that is another reason why I kind of shy away from ULIPs.
I actually did an analysis, I think, for one of the Yahoo articles I wrote. I'll send you that. I was just comparing the NAV performance. So forget all the other costs, forget everything else. Just, take the NAV and compare it over the last 5 years or 4 years. And I found that HDFC equity fund, which was one of the good funds earlier. It's not one of the top 10 today, but still, that has outperformed one of the best ULIPs in the business. I think that was ICICI's lifetime ULIP aggressive plan, by a factor of, 3 or 4. So, it's like, even if you compare just the NAV, some ULIPs just haven't matched up.
Right.
Though I can't say that's the same case for everybody else. I know I did that comparison with one of HDFC's ULIPs as well, and I found that HDFC's mutual funds seem to have done better than HDFC's ULIPs.
Oh, really?
So it's probably a function of a lot of things, but ULIPs really have to demonstrate that they can do a better job, and there's no reason they can't.
Right, that's true.
So that's brilliant stuff. It was awesome talking about ULIPs, man.
Yeah, my guess is if we would have done this, technology talk maybe 3 months ago, I would have been hardcore. ULIPs are not good for anybody, but I've kind of come to the conclusion that it's good for some people. It just maybe not as many people as probably LA. The overall 80-20 rule, I'm sure all these ULIP providers feel like it's good for 80% of the population. I would say it's the other way around. It's probably good for maybe only 20% of the population. And I guess that's kind of where the disconnect is, and that's just my opinion. But I'm hoping that we could at least give somewhat of a balanced, technology talk on, ULIPs, and, it may be good for some people and, may not be good for everybody.
That's the point, actually. Sometimes it's easy to lose track because at least someone like me has been so pessimistic about it. I really want to say that, listen, you've got to make your own decision. I think this is a great conversation. It just brings to the light a lot of these issues that I would have loved to write about, but I feel a little squeamish because I've been so, anti-ULIP. So obviously there is something that is in there for some people at least, and like you said, maybe just 20%, but those 20% should benefit.
Yep, definitely.
Great
Sounds
talking. Good. Thanks a lot, Manish, and I look forward to talking to you again about lots of other topics.
Sounds good. Take care, Deepak, and we'll do it again soon.
Great, and thanks everyone for watching.